Welcome back to Investing Path, the channel where we explore the intricate world of finance and investing. In today's video, we delve into the controversial practice that has reshaped the American economy, stock buybacks. Join us as we uncover the origins, impact, and the ongoing battle over wealth distribution. From the stock market crash of 1929 to the resurgence of buybacks in the Reagan era, we will take you on a journey through history, revealing the choices made by corporations and their consequences on the broader society. We will examine the soaring CEO-worker pay gap, the decline of reinvestment in companies, and the far-reaching effects on local economies. But most importantly, we will raise the pivotal question: is it time for a change? So, grab your notepad, sharpen your critical thinking skills, and let us explore the contentious world of stock buybacks together. In the fall of 1929, the American stock market experienced a devastating crash, leading to a panic and a rush among investors to sell their stocks. This resulted in disappearance of fortunes and a significant decline in the value of American companies. However, corporate leaders devised a strategy to protect their wealth while the rest of the country suffered. They started buying back shares of their own company's stock from investors, effectively reducing the available stock in the market. This scarcity drove up the stock prices. Traditionally, companies would have had to introduce innovative products or business approaches to stimulate investor interest and increase their stock prices. But with stock buybacks, corporations discovered a different approach. They could inflate their stock prices without making substantial changes or advancements. This practice, known as stock buybacks, was a way of the owners of major American corporations to retain their wealth during the severe economic depression. This tactic played a pivotal role in reshaping the American economy and sparked a century-long battle over the origins and distribution of American wealth. At its core, this was a choice driven by greed and a disregard for the human element. It was a struggle over the source of American wealth and who should benefit from it. The option to save jobs and prioritize the well-being of employees was available but not chosen. In 1932, the New York Times highlighted numerous allegations of abuse in companies engaging in stock buybacks. These abuses included insider trading, where corporations used their funds to buy shares from individuals associated with the management. In response, President Franklin D. Roosevelt signed the Securities and Exchange Act of 1934, a law aimed at curbing manipulation and insider trading. As a result, corporations largely refrained from conducting stock buybacks. In the absence of buybacks, companies had three primary options for utilizing their profits: reinvesting in the company by establishing new factories and creating new products, increasing wages for employees, or issuing dividends to investors. Most American companies pursued a combination of these options, with a significant portion of profits allocated to reinvestment and wages. However, the situation gradually changed. Technological advancements and increased worker productivity led to a doubling of American workers' productivity and wages in the 3 decades following World War II, contributing to the growth of the American middle class. But this trend did not persist. Wages stagnated despite continued productivity growth. A new political and economic philosophy emerged, propagating the idea that government was the problem rather than the solution to societal challenges. When Ronald Reagan took office, the Securities and Exchange Act had successfully discouraged companies from engaging in stock buybacks for 50 years. To sustain the flow of money, investors restructured CEO compensation. Rather than receiving only a salary, CEOs were now eligible for bonuses tied to increases in the company's stock price. Given that buybacks quickly inflated stock prices, CEOs increasingly turned to this strategy. The amount of profits allocated to stock buybacks by major American companies rose from less than 1% in 1982 to a staggering 77% in 2008, just before the recession. Presently, companies spend approximately 65% of their profits on buying back shares of their own stock. The resulting pay gap between CEOs and workers in the United States has skyrocketed, going from a ratio of 15:1 to 220:1 within a single generation. A comparison of CEO compensation between General Motors and counterparts of Volkswagen in Germany and Toyota in Japan highlights the unique nature of this phenomenon in the United States. Notably, Volkswagen has refrained from buybacks since 2012, and the largest buyback years for Toyota are comparable in size to GM's smallest ones, as GM allocated more of its profits to executives and shareholders. Less remained for reinvestment and worker benefits. The repercussions of these choices became evident as GM's market share declined. The company closed plants across the United States, leading to significant job losses for tens of thousands of workers. The closure of the GM plant in Lordstown, Ohio, for example, had far-reaching effects on the local economy, impacting suppliers and other businesses connected to the plant. The closure also affected plans for a new hospital building and led to the closure of a local restaurant. The multiplier effect of job losses at the GM plant affected various sectors, including education, with students experiencing tremendous upheaval. In 2017, prior to the Lordstown plant closure, President Trump and Republican lawmakers reduced the corporate tax rate. The expectation was that corporations would reinvest their tax savings, benefiting workers. However, a non-partisan Congressional Research Service report revealed minimal wage growth among ordinary workers and a record-breaking amount of stock buybacks totaling to $1 trillion by the end of 2018. The prevalence of stock buybacks has been reshaping the American economy covertly for decades. As politicians take notice, there are calls for change. Senator Marco Rubio has proposed additional tax breaks for companies that reinvest their profits rather than conducting buybacks. Senators Elizabeth Warren and Bernie Sanders advocate for eliminating the Reagan-era rule that shields companies during buybacks and empowering the SEC to investigate such practices. Today, stock buybacks have become commonplace, echoing the patterns of the 1920s, and the American economy bears striking similarities to that era. The question now arises whether society wishes to perpetuate this status quo or pursue alternative paths. Thank you for joining us in this eye-opening journey through the impact of stock buybacks on the American economy. If you found this video insightful, don't forget to hit that like button and subscribe to Investing Path for more thought-provoking content. Now, we want to hear from you. Do you think it's time to stricter regulations on stock buybacks, or are you in favor of maintaining the status quo? Share your thoughts and join the conversation in the comments below. And remember, knowledge is power when it comes to investing. Stay informed, stay vigilant, and stay on the investing path.